The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. If you have any questions, it's 877-927-6648. And I would like to wish everyone a very happy Chinese New Year. It starts yesterday, and it is the year of the snake. Last year was the year of the pig, and the year before that was the year of the tiger. But this is the year of the snake, and of course, as most people know, snakes are one of the most feared objects, that and spiders, on the planet. And it's interesting that the last time we had a year of the snake in Chinese culture was in 2001, which was, of course, the World Trade Center, and then the one before that was 1989, which there were two things that happened. One was Tiananmen Square, and of course, the last one, which came in November 1989, was the fall of the Berlin Wall, and it was those were very important things. I remember 1989 very vividly. I have to take you back to memory lane. I was writing a newsletter called Astro Cycles, and I wrote in the letter that I believe it was November 9th, 1989. There were so many astrological things coming together that it was just truly amazing. And I told everyone who subscribed to my letter, and I had quite a few subscribers, I said that if this is not on every paper in the free world on the day or day after, within 2 days of this event, I said I will write the newsletter for free for 1 year for everybody. And the market did absolutely nothing on November the 9th, and yet it was one of the biggest days ever, as it was the fall of the Berlin Wall. So luckily I didn't have to work for free for a year, but anyway, that's the way it goes. The first chart that I put in today goes back to 2009, and it shows the market bottoming, on that March 5th and 6th date. That number that we hit, 666 in the S&P, was the 61% retracement coming off the 1982 low. So that was, a very important point. I'm going to put some longer-term charts in here today just to give you a pretty good idea of where we've gone and where we've been and what's been happening. I mean, most of you know what's been happening and stuff, but we'll see. But frankly, this is such a critical level. I've been saying that for a couple of weeks now, but I did some research, over the weekend, and I think I have found something that I might have, well, I'm sure not might have missed, but I did miss. And basically, what it is I want to compare the transit charts. These are astrological charts. In other words, if you were looking down at the universe, like maybe God does when she's looking, if you look down into the universe and saw how the planets were lining up, this is what you would be seeing. And these transit charts are showing, where the planets are within the different houses. Well, if you'll look at the one on the left, it is the one from March the 5th, 2009. And if you look at the one on the right, which is February 10th, you'll see that they're all lined up in the same houses. I mean, it is truly an amazing scenario. You don't find things like this very often in cycle theory. And so whether this means a great deal or not, I don't know. I'm pretty sure that it does, but it does mean that there are a lot of cycles that are coming together at the same time. And usually that'll be an inflection point. Of course, we all know that this is, yesterday was the new moon of the year of the snake, but that's a much shorter term cycle. So just keep in mind that that's it's a pretty big thing, to be watching. Now, the next chart that I wanted to show was to show that relationship on a monthly basis of the cash S&P and what the pattern is doing at the present time. And as you can see from this long-term chart, after we made the double top in February of 2007, we had the big break because of the Lehman Brothers and Bear Stearns and all the other things that happened, and the market stopped exactly at the 786 retracement of the low from 1994. And now what we've done is we've completed a very large ABCD 3-drive pattern extending over 3 years, 2010, 2011, and 2012. And here we are in 2013. So this is what is looking like, pretty good. You cannot dismiss, the Chinese, the New Year, and the way that they look at the zodiac, because it's been around thousands of years, and people are very good at interpreting, things that are there. I don't go into that esoteric stuff very often. In fact, I never do. And I try to just look at the numbers. That's all I'm really looking at, when I'm trying to, look at these things on a, longer term basis. Now, the next one that I wanted to look at was the one we just spoke about, which was the New York Stock Exchange Index, and the fact that when we made the low in March of 2009, that was an exact 61% retracement of the low from August 9th of 1982, which was one of the largest astrological dates that we've had. We had 6 conjunctions and oppositions that day, and that was a very, very important date, and we made that date down there at 61% retracement. That's why I call that date on March the 5th the point of no return. And when I was getting ready to write the newsletter this week, I remembered I said that this is the point of no return, and I was going to title the newsletter, "This is the Day I Quit." And I was going to say that, if this doesn't work, I quit, but I'm not going to quit. It just means that I'm wrong, and I'm wrong quite a bit. So this is really important where we are, folks, because if we turn down from here, they are not going to take any prisoners. This is my opinion, of course, and been hanging in here for a couple months looking for a top in here, but with looking at all these different cycles that occurred that I did miss. And in fact, I wouldn't have gotten this one with the exception, or with the fact that it was Chinese New Year, and I wanted to just take a look at it. And when I saw that all the patterns lined up just like they did in March of 2009, then I said, well, this has a higher probability now, in fact, that we're over the new moon. But, the market hasn't come down yet, but we'll see if, in fact, this is going to, to be coming down. I will... all I know is that you need the Dow to get down about 300 points on any one day, and then you'll have a pretty good idea of where you stand. If you go back a little bit farther on the NASDAQ and go to the high that we made in the NASDAQ when we were in the parabolic move, when everything was going up 15-20% a day into March of 2000. Then you'll take that as the top, and you realize that we've just completed a 50% retracement of that top. Now, this index is a little difficult because many of those stocks that were $100 and $200 and $300 a share, like CMGI, which went bankrupt, and WorldCom, and a whole bunch of others, they don't exist anymore. So that made the index drop, but the NASDAQ dropped 85% between 2000 and 2002. People forget that the market can, move down very, very fast when it finally does turn. So just remember that on the long-term monthly chart, that's all we've done is we've made a 50% retracement in that particular chart. So I think that that's something that you have to keep in mind, because it's very, very important. Now, the next one I wanted to take a look at is the fact that we have on the S&P cash, we're completing this very large butterfly pattern, and it's completed a perfect ABCD. We talked about this level in the cash of 151.93. The high has been 150.189, and so we will see how this is going to unfold here over the next few days. But the numbers are there. The question is the market going to capitulate and go to the downside? We've looked at a lot of things, like the bullish consensus, and there is giddishness in the market. but giddishness can stay a long time, just like it did in March of 2000. But this isn't the kind of market that we have at that particular, at this particular junction. There's just no other way about it. Now, we have some really strong divergences here. If you believe in the Dow theory, we've had a double top in the transportations, and the Dow Jones Utilities has just barely made a 61% retracement of the move from last August. So that also tells us that there's some discrepancies there that really are worthy of paying attention to. Now, the next chart, that I have a lot of charts today, folks, because these patterns, they're everywhere, and I think you really need to pay attention to them because they happen so much. But the New York Stock Exchange Index has just completed a 1.618 expansion. It's made a huge three-drive pattern and several ABCD patterns in it, so it has certainly completed, its part in this also. And that to me is the broadest of the indices because that's the one that really takes you, from where you've been for a long time, and it shows you. The last one, not the last one am I talking about? I've got to be here for 40 minutes. I wanted to show the Bradley model along with the Dow Jones Industrial Average, and the fact that we've had an ABCD move. The Bradley model was starting to turn on the 4th of February, and now this is the new moon on the 10th, and so if it doesn't turn down from here, then it's time to wait and see if we ever get a correction to buy it. But frankly, I think we will be turning down here shortly, and then there'll be some all hell to pay. As a matter of fact, that they're going to when the market goes up like this. Remember, any market that can go straight up can also go straight down, and that's usually what happens. We have quite a bit of wild volatility, and with I don't know if the year of the snake is going to do it or not, or what I think it is this volatility index is nobody's watching it anymore for a potential bottom, and that's the real problem here is that you're looking at something that is really, really hard to dismiss because the VIX index is extremely good at picking out fear and greed, and people have absolutely no fear at all. I have an aunt that is she's in 83, and I spoke to her just last week in Indiana, and she said I'm in the stock market for a long time, and I told her, I said, well, honey, I said, at our age, a long time doesn't mean a lot. And of course, we laughed about that, but that's just her way of looking. We got to take a little break here, folks. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and the next chart we want to look at is the chart of the S&P cash, which is the red line, and then the candlestick line is the DBA, which is the ETF for commodities. And all I would like for you to do, if you have a chance to come into Tiger TV, is just to take a look at what's happening with the divergence that we've had in this index. And this is, to me, I think, on an economic basis, has to be very troubling. Because if the economy was really booming like the stock market says it is, then these commodities should be at least testing some really, really strong resistance levels. And as you can see, they've been in a downtrend for a very, very long time. And that is usually not a good case when you have this much divergence. So it's something to consider, especially if you're in your 401ks and things like that. That's the basis of, looking at these things as the fact that they usually have a tendency to run together. So if the market is booming and they're selling a lot of products and buying a lot of things, they're using a lot of these raw materials to to build these products. And this is not what this picture is saying in the DBA. And just remember, we just came out of a tremendous drought across the Midwest, and we've had corn have about a $7,500 break to the downside. So, you have to keep that in mind. Now, the next chart that I'm going to put in, I think, is worth the price of admission. This is a chart of copper going back 3 years. And the thing that's important, I've circled with yellow circles on this chart, the area from July of 2011 and also where we are now. And you'll see what is known as a rising wedge or a flag pattern. and you'll notice that they're very, very similar. They have the three drive patterns within them, and they've held against these channels extremely well over the last month or so, and all you have to watch for is to see if copper can break below the 370 level. That's only 2 cents away from where it is now, because if it breaks below the 370, it's going to take out the last week's low, and that will also penetrate the bottom part of that pennant and or flag, and you should see a strong move to the downside. Now, the question I pose for you is that this stock market has been going up since 2009. But since 2011, in February of 2011, 2 years ago, we had a copper that was selling for $4.70 a pound. It went down to $2.90 a pound, and now it's setting at $3.70 a pound. If everything was really bullish, like the stock market is telling us, wouldn't copper at least be taking out the September highs or the highs from February of last year? And remember, it topped in February of 2011, it topped in February of 2012, and here we are, February 2013. We got a call from Mike in Lakeland. Are you there, Mike?
Yeah, hi, Larry.
How are you? What can I do for you, my friend?
I wanted to talk to you about the bonds, and we very much enjoy everything you do, and we as well trade pretty much the signals, very similar to yourself. Learned a lot. But I do have a question on the fundamental side where we discussed what's going on. I want to run this by you because what we keep hearing is that we have to come to grips, I guess, the Fed's involvement. But them saying that, okay, if the market is bad, and I guess we're doing this for 4 years, if the market is bad, then the Fed is going to keep easing money out. And we know we don't want to be in bonds because they don't, we can't get a return. So we'll speculate and we'll go into equities. And then on the other side, it's kind of like heads they win, tails that, they win. And then they say, and on top of that, if we keep bidding up the market and keep going, ultimately the economy has to get good. And if it doesn't, he's going to keep doing this. But if it does get good, then he's going to jack interest rates probably once or twice, and everyone in the bond market is going to get croaked, and we're going to go even higher in the equity market. So I think he's got things so distorted, and he's got them so far out on the risk curve, so far out over their skis, that, they're ahead of him, they're ahead of the economy, and they just keep going. And I'm seeing the same divergences that you see, and it's like incredible. I mean, how this thing is going to resolve itself. Does any of that make sense?
It makes sense, and I tell you what, Mike, I can understand you're thinking that way, but frankly, about 30 years ago, I stopped trying to think that way, and I really did. And I'll tell you why, because I would just absolutely it would drive myself nuts. All I really try to do now is just look at the price charts and see what they're going to say. But you're right. I can see all your analogy of what you're seeing is absolutely correct. Question is when. We got to take a little break here. Stay with us, Mike, and we'll get back after the break. Okay, it's a long break, so stay with us.
You bet.
Okay.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Gee, Mike, are you still there?
Yeah, I am, Larry.
Okay,
No,
Mike.
I'm very much with you, I guess. And I was going to ask you, I was just making a list of the divergences, and we're seeing the same as, oil. We think the bonds are holding in. We see the dollar getting stronger. We see the euro at resistance, and but I guess my broad question is this then, Larry. If this does resolve itself in the markets, the indices catch up with these divergences, do you think, in your experience, that this will happen while the markets are actually open, or is this more likely to occur in an overnight session over a weekend?
No one can really know that. There could be an outlier event that come in, like a war between China and Japan, something like that, or a nuclear bomb in Iran, Israel going to a war with Syria, something like that. But on the other side, it could be something, really super positive that, they find that there is actually gold in Fort Knox. I don't know what it'll be, but, I don't think about those things, Mike, because I just look at the price of the bar. If the prices are going up, people are buying. If prices are going down, people are selling. I posted into Tiger TV what I think is the ultimate divergence, and that is the price of the cash S&P going back through 2006. And then I put the yield on the 30-year bond and overlaid it. And as you can see, it has a very high correlation, with the exception of the last 18 months when, the stocks have gone up and, bonds have gone up, because everybody's, searching for yield. Well, this is probably going to be the thing. If anything is going to bite someone on the rear end, it's got to be the credit market, because it's a lot bigger. The bond market's far, far bigger than the stock market. And when you stop and think how many bonds Japan and China own of ours, if rates start to rise, that could be, the outlier. This is the $1 million trade that Bill Foster talked about a couple months ago.
I can hardly barely see it. Where did that divergence start? Is that in November of last year?
That started actually in October of 2011 when it really started to diverge badly.
That is wild.
Yeah. That's the thing that I'm keeping an eye on. If I had a wish, my wish is that we have one more jab up in the bonds, maybe another flight to quality of some kind, so we could get the bonds up to maybe they're 143 now. If we could get them, say, to 149, 150, and maybe even making a new high at 153 or 54, then I would really be interested, on the short side of them. But right now, if they're in a very quiet trading range. They've held the 61% retracement perfectly, so everything is normal in the markets. There's nothing really strange. We're just over some big cycle stuff. That's all I know.
In that environment, if the bonds were to get back up there, would you think that on their pullback that the market would resume her rally again, or did she go down with the bonds?
I look at each one separately, my friend, because they are separate. Right. The people that trade the bonds are different than the people that trade the stocks. That's that's the basis of what you're looking at. But with people looking around for yield, it just happens to. I happen to know someone that put $500,000 into a 90-day CD, and I couldn't believe that the yield on it was 0.9%. Less than 1%. That's only $300 a month, and it's really quite amazing that it's that way. But who knows?
Thank you, Larry.
You're welcome, Mike, and thank you very much for calling in. I certainly appreciate it.
You bet. Yeah. Bye.
Oh, okay. The next one we need to talk about, folks, is something that's happening right now, and that is the gold market. I put in the newsletter this week that I thought we were going to have one more move down in the gold and the silver because we were making a really nice Gartley, and right now we're completing that pattern. It comes in around the 1642 level. The low today has been 1644 so far, but it has held up relatively well, and so far anyway. But it's down hard. It's down quite a bit, more than $20-some on the day. When you have a wide-ranging day like this, a wide-ranging bar, you must exercise, a great deal of caution, because that tells you that you don't want to try to catch a falling knife. The easiest thing to do is wait a day or so, and if it holds up, that's fine, because if it gets below the 1627 level, folks, you have some real serious problems in this gold market. Now, on the positive side of this, because we can look at the poor man's gold, which is the silver, and silver is holding up really nicely. It hasn't even taken out the lows of last month, which is really a good sign, and it is still 40 cents away, from the target that we were looking at down around 30.40, the one that we talked about last week. Oh, by the way, I will not be on the show on Wednesday. I have some business that I must take care of that pulls me away in the morning, but I will be back on the show for Thursday. So we need to keep an eye on the silver futures around this 30.40 level, and the gold gold gets below 1640. It's going to challenge probably the old low at 1632, and if we break below 1632, that low is 1627. If we break below 1627 in the move, then I would think that we were going to be looking at something, far, far sinister in this market, over very, very shortly. Anyway, that's the way I'm looking at it, at least from a technical perspective. And as you know, I don't really look at the whole thing as far as a fundamentals, because I don't understand them. I don't think anybody else does either, but that's just my opinion too. So someone asked me to talk about lumber, and lumber is relatively thinly traded, folks. It really is not a trading vehicle that most people are used to or anything, but we are making a a big double top up at the 786 retracement at 390. I think it's a cubic feet in lumber is the way they. It's been so long since I've traded, I don't even remember. But we've had some strong resistance up here at this 390. It broke about $30 and then came right back and tested the high again. But it's frankly, for a trading vehicle, there's so many other things that you can look at besides lumber that it's not really worth the effort. That's the bottom line of what I'm at least thinking about at that particular junction anyway. I want to talk about the Japanese yen here because we're at a real critical level here. In the Japanese yen, the U.S. dollar, has held that 79 level that we talked about. But this Japanese yen chart on the versus the U.S. dollar on a weekly basis, it shows if you go back to last September, and if you look at the cycles that have formed, you'll see that the cycles crested right in the middle of the cycle, of the 48-week cycle. And this is where we are right now. We're in the 48-week cycle right now. We've had this tremendous move up. The 786 is hovering up here about another 2 points, which we could certainly make the 95 level without too much trouble. But this is the area where you certainly don't want to be too long the Japanese yen, just based on the cycles that we're looking at in the yen over a longer period of time. Someone asked me if I would repeat my numbers in gold, and I said the number on the downside that we're looking at today was around 1642. That completed the ABCD at the 786 retracement. The low so far today has been 1644. If we go below 1640, I believe that sets up a retest of the 1627, and the 1627 is the long-term daily 61% retracement. And if we break that, we have broken the back of that gold market, and it's not going to be going up for a considerable length of time, in my opinion, if that's the way that the cycles form. Maybe it takes it out by a little bit and traps everyone, I don't know, but it's an important number down there at 1627. But before it gets there, it's got to get below 1640. So this is what we're looking at. The easiest thing to do is to try to buy the gold. But with this big down day that we have here, your risk here is only about $6 or $7. But you're staring at this really wide-ranging bar in gold down $25, and it's not smart to try to catch a falling knife. That's the way that I, view it, because it's all about risk. It's not a question of, how much money you're going to make. It's, how much money, you're going to, have at risk. That's the whole thing of what you want to be looking at. That's the main thing, in my opinion. We've spoken about the bonds, and we've talked about silver on the shorter term basis. On the longer term basis, we've already come down now, and we're not going to make this ABCD pattern on the upside because we broke below that point, and that tells us that that's why we're looking at lower prices coming in silver, about $1 lower from where we closed on Friday. So you have to sort of respect that because it held up at such a really, really good spot. Now I wanted to spend a little bit of time here with the U.S. dollar because we have made some major moves here over the past year or so. We stopped at the 50% retracement last September. Then we had a nice little Gartley pattern form up around that 81 level, and now we've come down and we've made a little butterfly pattern down at that 79 level that we talked about so many times. And now we are approaching a possibility of the U.S. dollar index breaking out to the upside. We need it to get above the 81.50 level for a really significant breakout, and that would determine that yes, you are breaking out in the U.S. dollar, and that will surprise a lot of people because no one thinks the U.S. dollar can do that. By the same token, if you go back below 79, then all bets are off, and you'll be looking at much lower levels. Someone asked me a question. If you had to look at one thing, what would you look at? Well, there's no such thing as looking at one thing because all of them are fit together. But if I had to pick something, I think I would pick copper, because if copper goes below $3.70 a pound, that's going to signal that, something is really seriously wrong with copper. And copper is used in so many things that it would tell us that it would really look like the market would have a move to the downside. The second thing I would look at would be the long bond. Look at that 30-year bond, because if the 30-year bond starts getting above about 2 points from where it is now, if it gets above the 145, 146 level, that means rates are going to be dropping. It's going to be another flight to quality of some kind, and potential for a market move maybe to new highs, because it held at the exact 618 at 142.05 last week. I mean, it was to the exact tick. And so that tells you how important that is. Now, if that's broken, then, the interest rates are going to rise, and I still believe that's the, going to be one of the big trades of the year. We talked about the Japanese yen earlier in the year, and that's certainly starting to move, but I think the credit market one will be something that will be, very, 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 very important to look at. Now, I wanted to cover one of the other things that Basil always covers on his three dollies, and that is, the VIX index. We haven't made new lows yet, whereas the market has. That's telling us that there is no fear in the market, and there's certainly a whole lot of complacency. So that's another thing that we want to be watching very, very closely here is this VIX index, because when fear does come back to the market, and inevitably, well, it'll come back, but the reason why is the market only operates on two things: fear and greed, and fear is a greater emotion than greed. That's why markets drop faster than they go up, because fear has actually physical characteristics that greed does not have. Fear, you have dilated pupils, diaphoresis or sweating, you have white knuckles, the chalky mouth, all of these things. The reason why I know, I have a picture of myself showing fear, right here in my wall to remind me. So fear is a greater emotion, and that's why markets come down much faster than they go up. And politicians use this as leverage. If you remember in 2008, Paulson was saying, if we don't pass this $770 billion TARP program, it's the end of the world. We're going to close all the financial markets, and the banks are all going to go under. And, of course, Congress came in and gave them the money, and sure enough, the banks did not fail. They were too big to fail. So that's what happened. And then Mr. Bernanke now has had QE1, QE2, QE3. I don't know how many numerals he's going to do in this, but I think that before it's all over, these QEs might turn around, and maybe because it's the year of the snake, maybe that's who it's going to bite. I don't know. But it's not a good thing when you keep pumping in money, trying to prop up, physical assets, like houses and stocks and stuff like that, because markets don't operate that way. We've got to take a little break here, folks. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
And I have to answer a question from one of our favorite people in the Tiger TV family, Becky. She says, I'm trying to figure out what do we do if we have no money. And this is my opinion, folks, and I'm not a doom and gloomer by any stretch of the imagination, but I believe it's important that everybody should have at least $1,000 worth of silver coins. I mean, it doesn't have to be $1,000 face value because that's a considerable amount now. That's around $30-some thousand, but you should have $1,000 of small coins, either dimes or quarters, because if we lose the Internet, and, you know, who knows what, these guys are pretty smart out there, these young kids, and if there happens to be a cyber terrorism thing, then, you know, and they turn off the registers at the drugstores and the supermarkets and stuff, it might last a few weeks or something. I believe you should have enough water for a couple weeks, and you should also have some food, some dried food around, canned food, whatever you need, just as a safety mechanism. I get laughed at a lot in my family about that, but, you know, I do keep a little around, always have. And I'm not going to change now, too old. The old dogs don't roll over at my age as easy as they used to, but I think there should be a little bit there just so that you have it as a, you know, a protection of some kind. Certainly don't go to the extremes. You know, that's, you don't need a generator, and I wouldn't worry too much about the bullets. And cash, I don't know how much that would be. I think cash is always good to have around. And some silver, and gold is too expensive, so people will, and it's too easy to counterfeit. So it's important to realize that that's important. I want to get back to trading a little bit here. I mean, that's stuff that might never happen, but that's just my opinion of things. One of the best things as a trading vehicle for if you like to day trade or trade over a couple-day period is to look at the crude oil market. It matches gold as far as the beautiful patterns that it makes. And I posted into Tiger TV here the beautiful triangles that have been happening for the last 6 weeks in crude oil, that shows how the rallies have been equal and how they go up to the 61% retracement and how they make A, B, C, D patterns. As a matter of fact, today's low was a perfect A, B equals C, D pattern over the last 3 days, and all it did was take out the low of February 6th by just 2 cents in crude oil, and it immediately rallied $2,000 a contract. And it's, if it was really negative, it would have gone through that low and probably, extended down to the 1.27. But in fact, it did not, really do that. I have another question about Apple. Apple's had a 10% rally now off of the bottom. I still believe we have a strong chance of making that other ABCD pattern down at the 394 per share level. So I'm still looking at that. If Apple closes above 505, then I will assume that that target was actually not met, and we'll have to look at another alternative to it. But right now, I don't think there's much to change my mind that Apple cannot make that level. It's just correcting a very, very oversold condition, and of course it's in the news now because they have something like $130 billion in cash, and they want to distribute it to the shareholders. So we'll have to see how that plays out in the news. But frankly, just look at the charts; they'll give you a pretty good idea of what's happening. So the key thing to watch, folks, is if we get a move down in the Dow, and it's got to be a doozy. 250 points. Anyway, listen, live every day in an attitude of gratitude, and may God bless each and every one of you.